Welcome to Griffonomics. Today, we are opening up a file that is, well, it's being written as we speak. It is Tuesday, February 3rd, 2026. If you've looked at a trading screen at all this morning, you already know the story. PayPal ticker PYPL is currently down, about 16% in pre-market?
Oh, it's a sea of red. And honestly, the stock drop is just the symptom.
Just the symptom.
The real story here is the absolute capitulation happening in the boardroom.
Capitulation is the right word. We aren't just looking at a missed earnings report. We're looking at a full-blown leadership purge.
Yeah.
PayPal has officially ousted CEO Alex Chriss. He lasted 30 months.
Which, in corporate years, that's a blink of an eye. You barely have time to change the letterhead in 2.5 years.
Right.
But the board clearly saw enough. They've already tapped his replacement, effective March 1st. Enrique Lores.
The HP guy.
The HP guy. He's currently the CEO of HP Inc. And was sitting as PayPal's board chair. And, that choice tells you everything you need to know about what PayPal thinks its problem is. You don't hire the guy who runs a hardware and printer giant if you want some kind of visionary product revolution. You hire him if you want ruthless operational efficiency.
Exactly. This is the melting ice cube thesis in action. The sources we're looking at today paint a picture of a company just desperate to stop the bleeding before that ice turns into a puddle. So let's strip this down. We need to look at the business model, where it's failing, this financial mix shift that's just killing their margins, and then this new three-pillared survival plan.
Let's start with the business model.
Yeah.
Because reading through these Q4 2025 reports, it is so obvious that PayPal is suffering from a split personality.
Yeah.
It's what analysts are calling the tale of two cities.
Right. You have City One, branded checkout. This is the golden goose.
Yellow button.
It's the yellow button. It's pay with Venmo, high recognition, and historically just massive profit margins. But looking at the Q4 data, that goose is sick.
Terminal, maybe. Yeah. In the fourth quarter of 2025, branded checkout growth slowed way down to 1% on a currency-neutral basis.
1%.
Just one quarter before, it was at 5%. For a growth tech stock, 1% growth is effectively death. Yeah. It means inflation is literally growing faster than your core product.
And that drags us right to City 2, the workhorse. This is the unbranded processing, what used to be called Braintree. This is the plumbing. When you buy a t-shirt online and just type your card numbers into a generic form, PayPal might be the one processing that on the back end.
And that part of the business is actually, it's booming.
Right.
It's growing at 8% and now makes up 43% of their total volume. But here is the trap.
It's the margins.
It's the margins. It is so low margin. It's a commodity. You're competing on price against Stripe, against Adyen.
So the high margin business is dying and the low margin business is growing.
Exactly.
Yeah.
It's what we call empty calorie growth.
Yeah.
You get the revenue number, but you don't get the nutrition, the profit.
Right.
And this is causing what they call the mix shift. Because the low margin stuff is becoming a bigger piece of the pie, the company's overall profitability is structurally declining.
So it creates this paradox where the company looks bigger on paper, but it's actually getting less and less healthy. And we can't forget City 3, which is Venmo. That seems to be the only real bright spot in this whole report.
Venmo's interesting because it's finally growing up. Revenue surged 20% to $1.7 billion. They've managed to evolve it from just, sending my friend $10 for pizza.
Yeah, P2P.
Into a legitimate commerce platform where people are actually buying things.
Yeah.
But, and this is but Venmo alone cannot carry the weight of the stalled branded business.
Yeah.
It's a rising star, but it's sort of orbiting a dying planet.
Which explains the earnings miss. They reported revenue of $8.68 billion and non-GAAP EPS of 1.23. Both missed Wall Street estimates.
Yeah.
But the killer metric, the one that really matters, was transaction margin growth. It slowed to just 3%.
And that right there, that violates the rule of 40. Investors love the rule of 40, where your growth rate plus your profit margin should equal 40.
Or get close.
Or get close to it. PayPal is failing on both. They're growing slowly, and their margins are compressing. That is why the stock is down 16%.
And frankly, it's why Alex Chriss is out of a job. The board statement was, it was brutal. They said the pace of change just wasn't fast enough. They don't want a vision for 2030. They want the plumbing fix now.
Which brings us right back to Enrique Lores. He is a cost-out, efficiency-in kind of operator. He managed the decline of the printing business at HP by extracting maximum value from a mature asset.
So the board is basically admitting it.
They're admitting PayPal is now a mature asset that needs discipline, not a growth rocket ship.
And they've even designated 2026 as an investment year.
Which is just corporate speak for our profits are going to be flat because we have to spend a fortune to fix this mess.
It gets worse. They formally withdrew the 2027 targets they gave just last year.
That is a massive, massive credibility hit. When you pull your long-term guidance, you're telling the market, we actually have no idea what's going to happen.
So let's look at what they are going to do. Loris has the strategy to save the branded button. The plan highlights 3 pillars: experience, presentment, and selection. Let's decode these, starting with experience.
Okay, experience is basically code for biometrics.
Right.
The biggest enemy of PayPal right now isn't really Apple, it's friction. Passwords are friction. If I have to remember my PayPal login from 5 years ago, I'm just going to double-click my iPhone and use Apple Pay. It's that simple.
The data on this is wild. Only 36% of their users are considered checkout ready.
36%.
Meaning they have Face ID, fingerprints, or passkey set up. That seems dangerously low for a tech giant in 2026.
It's an abysmal number. I mean, think about your own behavior. If you had a checkout page and you have to type in a password and there's another button that works with your thumbprint, which one do you click?
The thumbprint.
Yeah.
Every single time. Not even a question.
Exactly. So their goal is to get that 36% up to 50% by the end of the year. If they don't, they lose on speed. And on the internet, speed is the only thing that matters.
Okay, so pillar 2 is presentment. This feels like a battle for screen real estate.
It is. It's the battle for the button.
Yeah.
Usually, you only see PayPal at the very end on the checkout page. But by then, you might have already autofilled your card info. Presentment means moving upstream. They want the Pay in 4 button or the PayPal logo right next to the product price before you even hit Add to Cart.
That's smart psychology. If I see pay $50 a month right next to a $200 pair of sneakers, I'm way more likely to convert.
The data shows it lifts volume by over 10%. But, they have to convince thousands of merchants to redesign their sites to allow this. It's a ground game. They have to fight for pixels on the screen.
And finally, pillar 3, selection. This is the rewards war.
This is them basically admitting that convenience isn't enough anymore.
Yeah.
People use credit cards because they want the points. They want the miles. So PayPal is launching PayPal Plus, a rewards program in the US and Europe. They're trying to, bribe you to click the yellow button.
It's a flywheel attempt, right?
Right. Use PayPal. Get points. Use those points to buy more stuff with PayPal. But all of this, the rewards, the tech upgrades, the merchant integration, it costs money. A lot of money.
Which is why they warned that EPS will be flat to down. They're taking all their profits and just pouring them into building this defensive wall. Speaking of pouring money, we have to talk about the buybacks. This part of the report really stuck out to me.
Oh, yeah.
PayPal is projecting over $6 billion in free cash flow in 2026. And they plan to spend $6 billion on share repurchases.
The 1-to-1 ratio. Every single dollar of cash they generate is going right back out the door to buy their own stock.
So is that a sign of confidence, or is that just financial engineering?
Well, it depends on how cynical you are. The charitable view is, our stock is cheap, this is the best investment we can make with our cash.
Okay.
The cynical view, and I think the one I lean toward, is that this is artificial life support for the EPS number.
Explain that for our listener.
Sure. Earnings per share is a fraction, right? It's net income divided by the number of shares.
Yeah.
If your net income, the numerator, isn't growing because your business is stalling, the only way to make the EPS number look good is to lower the share count, the denominator.
So they're shrinking the denominator to hide the lack of growth.
Exactly. It's like burning the furniture to heat the house. It works for a little while, but eventually you run out of chairs.
And the house itself is under attack. We haven't even touched on the major external threats.
Yeah.
The checkout wars aren't against Visa or MasterCard anymore. It's against the operating systems.
Apple Pay and Google Pay.
Correct. If you own the phone, you own the checkout. Apple Pay is integrated right into the hardware. PayPal is just an app living in Apple's house.
It's a structural disadvantage. I mean, no amount of disciplined execution can fully solve that problem.
Plus, the macro environment isn't helping them at all. They mentioned the K-shaped economy.
Right. PayPal's core user base, it skews lower to middle income. Those are the folks hurt most by inflation. The wealthy, who are doing fine, they tend to use premium credit cards like Amex for the points. So PayPal is getting squeezed from the bottom by the economy and from the top by the tech giants.
They even called out specific weakness in Germany, which has always been a fortress for them. That's a real crack in the moat.
So you have a very real value trap risk. The business might just slowly shrink in relevance year after year, just melting away.
Okay, but let's play devil's advocate for a second. Let's look at the bull case.
Go for it.
The stock is down 16% today. It's trading at a historic low valuation. Venmo grew revenue 20% to $1.7 billion. That's a real business now.
It is.
If Loris can just stabilize the boat, not even make it fly, just stop it from sinking, the stock could double from here, couldn't it?
That is the value play thesis. And Loris is capable of that. He doesn't need to invent the next iPhone.
Yeah.
He just needs to fix the biometrics and get the margins under control. If he could just stop the branded business from shrinking, the cash flow alone supports a much higher stock price.
So it really comes down to a race.
A race.
Can Loris execute these technical fixes, experience, presentment, selection faster than the users turn away to Apple Pay?
That's the whole variable. As one analyst note put it this morning, risk defined, portfolio protected. But that only holds true if the portfolio stops bleeding users.
It is going to be a fascinating year to watch, but I want to leave our listeners with one thought that really nags at me.
What's that?
It's the withdrawal of the 2027 targets. Just 12 months ago, this same company stood on a stage and told us exactly where they would be in 3 years. Today, they said, actually, we're taking it 1 year at a time.
It's a big slice of humble pie.
It is, and it just raises a question. If a company with 25 years of history, with mountains of consumer data, and billions in cash flow can't predict where it will be in 24 months, should you be willing to bet your capital that they can?
Uncertainty is the most expensive thing you can buy in the market, and right now PayPal is selling a lot of it.
We'll be watching closely to see if Enrique Loris can bring some certainty back to the table.
Thanks for listening to this deep dive on Griffonomics. See you next time.